Agree with Mike Wilson that we're on the way to some type of correction coming up, possibly double digits. We've had other people say similar comments that just because of this concentration that there's a lot of, volatility that could be coming up for the markets.
Right. I do agree that there needs to be some sort of shift, that it's very likely to have some sort of shift. I don't know if we necessarily have to have a full-on 20-cent per correction, but certainly some type of downturn and definitely some type of rotation. And that means a bit of a pullback from these leaders that we've seen, and maybe some performance that we can hope from some of our value or smaller cap stocks, even within the S&P 500. So I think, we've been calling for this type of rotation or this type of correction for quite some time, because the warning signals have been there for so long. And it's just really a matter of perhaps when and not if at this point when looking at the backdrop.
Aaron, it's interesting that you're talking about warning signals. Strategist out with the note yesterday that I was reading. I was bouncing off a bunch of people. I want to get your take on it as well. They say in part, the gap between the performance of the market cap and equally weighted index, talking about the S&P, has only been this wide in two other cycles, the late 90s and the late teens. Reversals from such wide gaps are often severe and rapid. It sounds like you were saying something similar, that the rotation is going to be pretty dramatic when it finally comes.
Right, exactly. And we see that whether you're looking at equal weighted versus weighted cap, or you can see some similar sort of extreme readings when you're talking about breadth or small caps. It really is a question of when investors either lose their appetite for those leaders, those mega caps, or finally are willing to take on a little risk and invest in some of the stocks that have been so ignored for the past year. And unfortunately, we've been wrong a few times in the past few years, and people are a little hesitant to jump because, like I said, the warning signals are there. But we really haven't seen the appetite for investors to shift into different types of stocks or different types of asset classes within the market caps.
We'll have to wait and see on that rotation. But I also want to focus on how you're seeing today shaping up. What's your WEX word of the day?
My WEX word of the day is disconnect. And that's really, what we've been talking about. Where there are just all of these warning signals, but the market isn't following through. I think for anything that happens to do with interest rates could trigger that rotation, as well as any big changes in expectations when it comes to economics, which might be further down the week and through earnings season.
All right, I want to get to your pick today as well. Your pick is the IY ETF. It's an energy ETF. It's actually the Spider iShares U.S. Energy ETF. I want to ask why this one? Energy basically lagging year to date, only up about 7%. And I looked at the top holdings. They're all oil companies. You say this is an AI play. I haven't heard a lot of people tie oil to AI.
Well, we do talk about energy usage and how ultimately electricity AI is going to further that electricity usage. A lot of that has been focused on the utility sector, but energy actually has already at least looked to put in a bottom around mid-June. So it's very early, but we do see a little bit of shift. I think the well-diversified energy companies, those ones where it's natural gas as well as oil, are ones that are well poised to play. If we do see this huge increase in electric appetite, we're talking about like a 20% increase over the next 4 years. These are companies that are going to benefit as well. And so I think they're actually look like they have some early sector rotation, just like we've been talking about, a little more so than utilities. And so that's my bet for as we shift into smaller caps and new changes.
Are dividends part of this story as well? Was, again, looking at the top holdings, I'm seeing a lot of dividends around 3% or higher. I mean, EOG is actually one of the lower ones in the top holdings at 2.9, ConocoPhillips at 3.4. Are you also looking at the dividends as kind of buoying what may be a lack of price action?
Absolutely, dividends, but really also these are some of your lower valuations, as well as just sort of the less favored stocks, talking about that sector rotation, really getting into more of a safety stock, as well as looking for potential growth.
Okay. Jay Powell on the Hill today. We're mentioning what's coming up later today. How are you viewing that, and what's your outlook when it comes to a cut?
Right. So I actually, for a while, didn't think we were going to have a cut for this year, but the recent deterioration in unemployment and the massive revision in jobs, as well as an increase in bankruptcies, I think those are the weakening signs. I think that actually is going to be the catalyst for a cut, rather than inflation really getting down and closer to that 2% goal. I think that's going to be what's pushing them earlier rather than later. And so I think, it is possible that we could see that cut within September, but more likely November. And I think we're not going to get a lot of information out of today's meeting.